One of my biggest takeaways of studying the Great Financial Crisis is that AIG has the world's greatest company name. And I wonder if this happened today, would their name have bailed them out, right? Would the multiple on their revenues...
You're talking about AI?
Yeah.
Artificial intelligence, G?
They can be the AIG, you know? Like, what a great name. And they just ruined it.
They ruined it.
Anyway, you ready?
Yeah, let's roll.
Let's do it.
Welcome to episode 3 of Crashes, where we study the most dramatic periods in financial market history. I'm Daniel Gamboa, and I led investment operations at Divvy Homes, a PropTech asset manager acquired by Brookfield in February.
My name is Matt Harris. I'm a managing partner at D-Mission Ventures and the CEO of a venture-backed startup called Architar. And we are your hosts. We left off our conversation about the global financial crisis at the end of 2006 with the crash of the housing market. Today, we're going to talk about how the housing bubble led to a full-on banking crisis and how all that unfolded. Set the stage.
I want to dive right into the middle of the crisis with an excerpt from Hank Paulson's book On the Brink, which I think we both read. You read that book, right?
Yeah, that's a great one.
Yep. So Hank Paulson was the Treasury Secretary for President George W. Bush, starting in July 2006 through the end of his presidency in January of 2009. And he was the key architect of everything that the government threw at the financial system to try to prevent a major depression. And so in the book, he basically walks through everything that was happening during that time period. It's sort of like the best primary source of how the government reacted. And so to set the stage, this is a chapter where he talks about what's happening on Sunday, September 14th, 2008, as Lehman is collapsing and they're finding out that AIG might collapse too, and they're trying to figure out what to do. So here I quote from the book. "A jolt of fear suddenly overcame me as I thought for a moment of what lay ahead of us. Lehman was as good as dead, and AIG's problems were spiraling out of control. The failure of a large financial institution would reverberate throughout the country and far beyond our shores. I could see credit tightening, large companies slashing jobs, foreclosures rising ever faster. Millions of Americans would lose their livelihoods and their homes. It would take years for us to dig ourselves out from such a disaster. All weekend I'd been wearing my crisis armor, but now I felt my guard slipping, and as I gave in to anxiety, I knew I had to call my wife. But I didn't want to do it from the landline in my office because other people were there. So I walked around the corner to a spot near some windows on the other side of the elevators and phoned Wendy, who had just returned from church. I told her about Lehman's unavoidable bankruptcy and the looming problems with AIG. What if the system collapses? I asked her. Everybody's looking to me, and I don't have the answer. I am really scared." And I love that passage because, Hank Paulson is this like no-nonsense kind of guy, tough guy. Everybody liked him, but, incredibly competent, very serious, leads from the front, not dramatic. And here he is effectively saying that he doesn't know what's going to happen. And I don't know, he's saying, I don't know if I can do this. I don't know if I can save the system. Like, we might all go down, and it's going to be another Great Depression.
And I think it's worth mentioning, I think we both agree on this. In order to study the GFC, this was the best book, I think, that I read, On the Brink by Hank Paulson. And it makes sense that it would be the best book, right? Because Hank Paulson comes from Goldman Sachs. He has a deep understanding of the markets and of Wall Street, but now he's the Secretary of Treasury. And so he is the guy to go read about. And I think it was also a very personal book, as you can see by the read here. But like I loved how he talked about his how his faith kind of worked in, how he handled it. Yep. And like he writes in the book several times that I gave this testimony to Congress to ask for TARP funds, and then I walked into the hall and threw up. Yeah. He was really detailed account.
Yeah, it's very real.
It was a really good book.
Yeah, I agree.
All right, so we left last time at the end of 2006. From 2003 to 2006, non-traditional mortgages like subprime and other products below prime dominated mortgage originations. $3 trillion per year, and actually 40% of all new mortgages by 2006 were in this category of subprime.
Yeah, huge.
This massive expansion of credit and deteriorating underwriting standards were fueled with mortgage-backed securities manufactured by Wall Street banks. These were all over the financial system in some shape or another, which we'll get into in more detail in a bit. And some of it was actually rated as safe as U.S. government bonds, right? So you had mortgage-backed securities jam-packed with subprime bonds, rated AAA, right? Rated right next to U.S. government bonds. By the end of 2006, loans originated in 2004 with teaser rates were defaulting as the interest rates stepped up from a teaser rate as low as 2% to a market rate closer to 7 to 8%. And it wasn't just the teaser rate in this point, right? Because the Fed is also raising rates, so you're getting the impact of the floating rate also. We talked about the triple whammy on the first GFC podcast.
I think they would have reset, but more to like 4 or 5%, which probably would have still needed some relief. But yeah, it made it way worse.
Right. Even some of the loans that were originated in 2006 were starting to default because underwriting standards had deteriorated so much. They were defaulting just months after the deal closed. These were the early payment defaults. And so you had mortgages being issued and defaults were happening in the first couple months. Did you happen to find a good source of data on all this stuff?
There's a great book called The Great American Housing Bubble by, I think they're two professors. One of the authors' name is Adam Levitin, and the other one is Susan Wachter. And they basically, it's a very academic book, but very rigorous and very analytical. And they go through this whole process of from the beginning how the bubble inflates with very data driven, a ton of statistics in the book, and then they talk about these early payment defaults. How by 2006 there's a ton of these subprime loans that within the first 90 days people are missing payments.
Yeah. I think the Mortgage Bankers Association website also has a lot of really good data. So I didn't get a chance to check that out, but a lot of the sources I read were from there.
Yeah.
And so that has a lot of really good data. But so here we are in December 2006, and this all had just started. This was the equivalent of January 2020 with COVID, right? Remember that being like, we're just going to have to stay inside for a week and it'll be fine. Like that's kind of what that was like. It's sort of the same thing here. The early signs were there, but it wasn't obvious at all that this was going to be a big deal yet. So much so that you had people like Ben Bernanke, who took over as chairman of the Fed, took over from Greenspan. He'd been on the committee for a long time, so he's not like brand new or anything. But you had Ben Bernanke and Hank Paulson thought the economy was fine and that the housing market was going to be okay, and they said very publicly many, many times. The S&P 500 had returned 15.6% in 2006. Core inflation was 2.6%, which was up a little bit from 04-05 when it was 2.2, but like nothing major red flashing, although, major arm waving that doesn't really include how housing was up 10% and 11% in 04 and 05 because of how the Fed looks at inflation. And real GDP is about 3%, right? So things look pretty good on the surface. In February of 2007, Bernanke actually said, our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy. And the lending side of that still seems to be healthy too. One thing actually I read in On the Brink, just that really helped me understand, and remember this book was written a couple of years afterwards, not during, is that, on the Brink, Hank Paulson said that, the subprime market was 1/11th. The subprime ARM market, right? The subprime adjustable rate mortgage market, which is really the problem area that Bernanke is referring to in his quote that I mentioned earlier, was 1/11th of the total mortgage market. And the total mortgage market was about 45% of the total debt market, right? So when we're talking about like the problem of subprime, we're really talking about 4% of the total debt market.
Yeah, so which is why they thought that this wasn't going to be a big deal.
Right. And so like we'll talk about this a little bit more in the regulation section, but like the simple thinking is that, capital buffers will absorb these losses, no price, the whole point of them.
Yep.
Because you're only talking about a real problem in 4% of the kind of a debt origination market. But as we'll learn as we go a little deeper, the Titanic here had already hit an iceberg, and it was going down, but just nobody knew it yet.
Yeah, and so I think in order to really understand not just what happened, but why it was missed, like why were Paulson and Bernanke so confident that this was going to be fine, there's a couple of puzzle pieces that I think we need to put together. One is how the banks work, and two is credit default swaps, which are going to play a pretty key role in all of this. So let's start with the bank. So think of a bank around 2004. You can picture the big players that come to be the protagonists of the GFC: JP Morgan, Bank of America, Citi, Goldman Sachs, Merrill Lynch, Lehman Brothers, Bear Stearns. They were in the money business. They still are, right? Like the ones that survived. They are in the money business. So if you're a senior executive, you might have said that you're in the business of making money from helping money be as productive as possible. Like that's basically what the bank does. You're not making widgets. You're not selling physical products in the economy. You're just trying to make money by helping money and companies be as productive as possible. So the banks have two main lines of business. They have what I call maybe whole company or like investment banking. And so these are the Goldman Sachs of the world. And at a very high level, the investment banker's job is to help another company raise money or to buy another company, make these big strategic moves, and they get paid for advice. So they'll get paid a percent of the transaction fee. Sometimes it's a fixed fee, but you get paid based on a transaction, based on a capital raise. The other side of the business is market making. And so, again, at a high level, when an investor wants to buy a stock or bonds or any security, they may go to a bank to facilitate that transaction, right? Because it's hard to find your counterparty and find who might, do that deal with you. Instead, you go to a bank. It's like a shopping place where buyers and sellers meet, and that, the banks are providing that as a service, and they take a spread of that transaction. We can talk about proprietary trading, which I think played a key part in this, which is almost like a third line of business for them, which is them trading their own books. They're investing their own capital. That's no longer allowed after the GFC. But those are the two main things that they do. They provide advice and do transactions, kind of mergers and acquisitions, or they market make. So historically, banks made most of their money from lending money to other companies. And there were two types of banks, which again is important. It's an important distinction here. So banks like JP Morgan, they have depositors that, you might have a checking account there or savings account. Whether you're a person or you're a company, you might keep some cash there. And then there are banks like Goldman Sachs that catered primarily to companies and financial institutions, right? Mostly focused on advice and financing deals. Commercial banks keep the loans that they make on their books. So JP Morgan might lend $1 billion to Exxon to fund a new project, and Exxon commits to repaying that loan over 7 years. For the most part, though, investment banks, they sell the debt. So when they help raise money, they help finance a transaction. They try to keep it off their books. Commercial banks funded loans from deposits. They weren't allowed to trade securities based on Glass-Steagall, which will get repealed. That was a law from the Depression era. So these commercial banks are not allowed to trade securities. Investment banks finance themselves with short-term debt from other financial institutions, and that's going to play a key role in all of this. They were also private before the 90s, right? So these are private partnerships, and they finance themselves largely with partners' capital. All of that to say that the people running commercial and investment banks had a lot of skin in the game before the 90s, and all of this started to change gradually. So the 70s and 80s made the model of making money from the spread between the bank's funding costs and the loans interest revenue extremely difficult. The Fed was fighting inflation aggressively, like we talked about in part one. So for example, if a commercial bank that might have been paying depositors 4% might be forced to increase that to 8% just to keep up with inflation and interest rates. But they might be stuck holding loans because they made them for 7 years that are only paying them 6%. And so that spread doesn't work. It's not profitable. The distinction between commercial and investment banks, though, went away in 1999 with the repeal of Glass-Steagall. And that, by the 2000s, all these banks were basically competing with each other across the board, across investment banking and market making. The other key development, similar to Glass-Steagall, is that there's this concept of Basel I, which is just the label for the regulation, international regulation around capital requirements for banks. Think of these as the financial cushion that a bank needs to have to protect themselves from losses. Remember, a bank is not using its own money to fund the loans that it makes. So a traditional commercial bank might be using depositor money to issue loans. This works for the bank, right, if you think about it, and for the depositors, because the bank will use the interest they charge on the loan to pay the depositors a portion of that, and then pay itself what's left. Depositors don't all withdraw their money all at the same time, so this is generally fine, but the bank needs to be able to deal with a higher than normal rate of depositors taking out money from the bank. That's usually less of an issue now that there's depositor insurance, but historically there were these bank runs where, it's like, if you've seen It's a Wonderful Life, everybody tries to take their money out at the same time and the bank collapses because they don't have that money, right? Like, that money is invested in somebody's house. It's invested in somebody's business.
One of the things about the GFC that I didn't realize is that there was a real bank run on IndyMac.
Yeah.
Like people lined up and the lines were around the building, and that was like one of the early signs that we were in trouble, is that there was like an actual real lineup at a bank.
Yeah. So suppose let's do a little example. So suppose that a bank takes $100 from depositors, promising to pay them a small interest. Let's say this is a savings account. The bank now has $100 in liability, so it owes those depositors $100 back. They also have $100 in assets, which is the cash that they have sitting in their sort of cash register. This situation isn't risky, obviously, right? Because the bank can easily return the depositors the money at any time because it's sitting in cash. But that doesn't make any sense as a business, right? Holding the cash isn't profitable for the bank since it doesn't earn any interest on it. And even if they were just to invest it in like government debt, that's very low interest, and they still have to pay some interest to depositors. They still have to fund their own operations. So to earn money, the bank usually decides to lend the $100 to a company building a factory, right? So let's keep going with the example. If the company might be financially strong, so the risk of default is low, but it's not zero. If something were to go wrong, right, like let's say the factory fails for some reason and there's no insurance, let's say, the bank might only recover $90 by selling the assets, the factory. That means that the bank is now $10 short, right? And so if the bank still owes its depositors $100, but they only have $90 that they recovered from the loan that they made, then they're insolvent. So to prevent this, to prevent bank operators from kind of overextending themselves, international regulators came up with this idea of Basel, which is capital requirements. So how much capital do you need to keep in cash or effective cash in order to absorb potential losses like we talked about, right? And so that's called capital requirements. So if the bank goes and if the bank gets $100 in depositors' money, they might only be allowed to loan out like $80. Don't want to get too wonky, but the sort of high level rules for Basel I are that banks are required to hold capital that was at least 8% of its risk weighted assets. The loans to companies were weighted at 100%, but mortgage debt was weighted at 50%, which meant that, if you actually lend Exxon or any other company, any debt, well, that's going to count 100% against your capital requirements. If you lend if you lend it in the form of a mortgage to a homeowner, that only counts 50%. So it's as if you had lent only the 50 cents on the dollar on that loan. So it's advantageous from a capital requirements perspective. You have to hold less capital, 50% less capital, if you're lending it out in terms of mortgage. And there's one more kicker, which is if you're actually lending it out in the context of a securitized mortgage, so now it's not just an individual loan to a borrower that's buying a home, but it's in the context of securitizing mortgage debt, especially if it was rated AAA or AA, then it's only 20% weighting. And then, of course, if you're holding U.S. government debt, that's as good as cash, so that doesn't count against your capital requirements. That's 0%. So that's basically Basel. So embedded in the capital requirements in the system, starting in 1998, is the fact that you as a bank owner or operator are incentivized to loan as much money in the mortgage market because it counts less towards your capital requirements. So you can use less equity and more debt to go kind of fuel growth and juice your profits. So why might that be important, right? So equity is expensive. The cost of capital for equity is more expensive than debt, and certainly more expensive than short-term funding like depositor money. So one way to increase your return on equity is to use less of it to generate the same amount of dollars in revenue, right? And so then you're going to go lever up as much as possible. There's huge competitive pressures on banks and on leadership teams in particular to maximize returns, especially after competition in major banking increased in the late 90s with deregulation, with the repeal of Glass-Steagall, where now there's more big banks competing against each other in these same markets. So my guess is that showing up to board meetings every quarter with metrics that were underperforming would have been pretty embarrassing, number one. And number two, would have probably resulted in getting fired. And so you as a CEO or as an executive in these banks are definitely incentivized to get after it and go do as much of these mortgage products as possible. By the way, what's more capital efficient than lending?
What?
Fees from trading, and especially fees from structuring very complicated financial products for yield-hungry investors, which are, a dime a dozen during this time. And that's exactly where the banks went in the 2000s. So we talked about in part one, the great moderation, right? Greenspan and others had tamed the markets. Volatility was low. Markets were considered efficient. The fees were high. Revenues were high. Bonuses were high. Competition was very intense. There's this perception that risk is low. And what, in addition to the great moderation, drove that perception of low risk in a way that also, on top of that, reduced capital requirements? Credit default swaps.
Credit default swaps.
Let's go.
I almost said it at the same time. Before we move on to CDS, just three quick things about Basel that I think are interesting. One is there actually is a good book out there about Basel, which is a little bit of a mysterious organization. It's called the Tower of Basel.
Ooh, haven't heard of that one.
If you really want to get really wonky on the global financial system. The second is one thing to note about Basel, right, is that you called them a global regulator. They're not a regulator; they're a standards body.
Yeah,
right?
standards.
So I think that's like a relevant distinction about like how all this stuff gets proliferated. The way it typically happens is a standards body puts out a standard, and then that has a different pathway to adoption in every country around the world. And then third, we'll talk about this in a second. Basel was the standard bearer. Most countries had adopted their standards, but one major thing that we'll talk about here in a second is that a lot of the mortgage market was happening away from banks. So a lot of it was happening just entirely away from these requirements. So, credit default swaps, otherwise known as CDS. We talked about credit default swaps a bit as insurance against the risk of default. The whole idea here is that a bank makes a loan. There's a risk always that loan won't be paid back. In some instances, it might actually make sense for you to go actually seek insurance for not getting paid back to that loan, from that loan that you made, especially if somehow getting that insurance reduces how much cash you have to reserve on your balance sheet, and it's just a good trade for you in general. CDS didn't just protect you from the default of a loan you made, it actually freed up capital that otherwise was just sitting dead on your balance sheet because of the way the capital requirements worked. Interestingly, the CDS market started where you and I began, which is in the oil and gas space.
Right.
And so, in
no spills.
That's right. There's two things in my life that make me that are like chicken noodle soup. One is talking about 1990s Yankees players, and two is talking about the small and mid cap shale companies from 2010 and 2020.
There's some major crashes that we might have to cover.
That's right. Yeah, we know a lot about those.
Yeah.
All right. So in 1994, J.P. Morgan was in a tough spot. One of their main clients, Exxon, they drew $4.8 billion on its line of credit. I actually didn't appreciate that it was a line of credit, not like a loan.
Yeah.
Okay.
Yeah, it was like a revolver.
Yeah.
Right.
So Exxon had a revolver out there that J.P. Morgan had already agreed to, and they drew down $4.8 billion on their revolver to fund the fine that they had been levied for the Exxon Valdez oil spill. J.P. Morgan couldn't say no and alienate one of their biggest clients, especially since they'd already contractually agreed to lend this money via revolver. But this was not good for them. They did not like having a $4.8 billion loan outstanding to even a company as safe as Exxon.
Yeah, and it wasn't very profitable, right? Like, this is not where they want to be putting in their capital.
Right. We're talking about, who knows back then, but we're talking about normally like LIBOR plus 100 basis points.
Yeah.
It's kind of like the typical credit facility for a company like Exxon. So they're not going to make much money on it. It's a big loan that requires a bunch of capital to be reserved on their balance sheet per the Basel rules. And in come a couple of bankers from the derivatives group, one named Blythe Masters, another named Bill Demchek. And they actually convinced a European bank, specifically the European Bank for Reconstruction and Development, comes in to do a swap deal where they took on Exxon's default risk in exchange for fees from J.P. Morgan. Actually very simple, kind of awesome, to be honest.
Great deal.
This was great for J.P. Morgan because it allowed them to both better manage their credit risk. It allowed them to do the two things banks are supposed to do, right? It allowed them to better manage their credit risk exposure because now they don't have an overly big loan outstanding, even to a safe borrower. And it allowed them to make their customers happy, right? I think that's a really important part to how probably all of this financial innovation started. It was all about being client-friendly, making your big customers happy, in a way that allowed them to optimize for their capital requirements.
Yeah, this is a great product, right? I think credit default swaps later on take on a terrible reputation, but the basics of a CDS, it's actually pretty clever.
Right. Yeah, it's a great way to solve the problem of how do we manage our credit risk, how do we keep our customers happy, and how do we do this in a way that somebody else will do it with us, right? How do we do it in a way that's attractive to our counterparty? So in theory, this was actually a step towards a much more efficient credit market. This is actually like when you hear someone like Alan Greenspan talk about how great derivatives are because they allow the separation of risks to be borne by the appropriate parties, et cetera, et cetera. This is like probably the best example that I've seen.
Yeah, very elegant.
And so at the creation of the CDS, you have this one really interesting deal between J.P. Morgan and a big European bank. And this makes sense. So what comes next is You need to create a market where banks could, on demand offload their credit risk kind of as they wanted to for a market-based price. The market needed to deliver attractive returns to the investors into these products that were taking this exposure. And this market needed to provide price signals on credit risk that would, in theory, make credit risk more transparent and make the credit markets more efficient.
Yeah, what do you mean by that? I think it's worth double-clicking into that. Like, what does that mean exactly, right? I guess, at least in my mind, tell me if you disagree, but in my mind it means up to this point, when you're lending, or if you're an investor investing in somebody's bonds, it's kind of hard to know exactly what the credit risk is associated with a counter or with a issuer, right? Because you can look at their bonds, you can look at spreads, but there isn't a specific price where people are actually trying to price the credit risk of a given issuer. And this basically provides that. Is that kind of how you think about it?
Yeah, I mean, I think when you think about credit, there's sort of three components to it, right? There's the risk-free rate, which you have the treasury market for that. And then say like a investment grade company wants to come issue debt. So you have the risk-free rate, you have time. Dollar today is always better than dollar tomorrow. And the third component is just how much more likely is this entity to default than the treasury is likely to default. Yeah. Basically, what is the default risk premium? And so if you have a product in the market that tells you exactly that separates that risk out and says the default risk premium for Exxon on a 30-year bond is blank,
and you can be more precise.
Then that makes it much easier to do transactions in and price things in the credit market, because this thing that's otherwise lumped into a thing of three now has its own spot in the world.
Yeah, makes sense.
So at this time for CDS, these are very sophisticated investors doing lots of due diligence before entering into this trade. And this market really takes about a decade or so to mature. By 1996, the year the Yankees won their first World Series in the 90s, the Fed agreed that banks could reduce their capital requirements associated with a loan if they executed a credit default swap. So you have this now. By the way, I think one thing that's happening big time in the real world, right, is that's one of the major promises of tokenization in the private markets today. Is that if they can tokenize all these private investments and make the private markets more liquid, then you'll have less capital requirements. Yeah, and so this is
so even though nobody's going public right now, we might tokenize everybody.
Right. And you'll not only it'll free up the trading, and it'll free up a lot of capital that's otherwise tied up because of you have to reserve more for illiquid stuff than you do for liquid stuff.
Makes sense.
In 1997, credit default swaps evolved and became a little bit more complex, a lot more complex. JP Morgan, with Blythe Masters, of course, leading the way, created a slightly new thing where they said, hey, instead of taking every single loan and putting a credit default swap on it, let's take a pool of loans and put a credit default swap on a pool of loans. This just feels like kind of an obvious. It's just an easier, easier way to get more things insured, right? Doing one-off credit default swaps was fine, but pretty tedious. The more efficient way is to just pool them all together and go get insurance on all your loans at once. The way this worked was that JP Morgan had a multi-billion-dollar loan portfolio. It had originated with clients like Exxon on its balance sheet. The best option available to them to free capital up, because they don't want to sell these loans, right? These are their core clients.
Right.
These are probably all good loans. Maybe they're just too big, etc. So the best thing available to them would be to write a credit default swap on a whole portfolio of loans with a special entity they would set up on the side. These were called special purpose vehicles, or SPVs. I think one thing we're going to learn as we study market crashes is that these things always show up.
They do.
These were big in Enron's story, for example. And the SPV would insure JP Morgan on that portfolio of loans, and JP Morgan would pay the SPV a premium every quarter or every month or whatever they agreed to do. The SPV actually raised money from outside investors to make sure it could pay JP Morgan if, in fact, any of these loans defaulted.
Yeah, these are fully funded, right? This is like fully funded insurance.
And the money that came in from those investors was parked in safe assets like U.S. Treasuries. So let's just say the most simple case, JP Morgan gets their portfolio of loans insured. They get a bunch of capital freed up, and they're paying insurance premiums to these SPV investors. Let's just say no defaults happen. That's probably what would normally happen. Not no defaults, but very few defaults. The SPV investors earn their return for not taking a ton of risk. and their return is based on the insurance premium that JP Morgan is paying plus whatever the cash earned on the treasuries that it owned. If a loan did default, the SPV would make JP Morgan whole on its loss. And here's where it gets a little bit more interesting, and you start to get sort of the tranching effect that we saw become very common during this time. The investors in the SPV could invest at different layers of the SPV. The first layer, the equity, absorbed losses first, usually up to about 3% of losses, but they also received a bigger portion of the interest from the SPV, so higher risk, higher return. The second layer, the mezzanine, absorbed the losses above 3% and up to around 7%. And then the third layer, the super senior layer, absorbed losses above 7%, but also received the least interest from the SPV. If that sounds familiar, it's because it's basically the same thing we talked about in part 1 with the tranching pattern with collateralized mortgage obligations. Similar to those, the super senior tranches were rated AAA, as safe as U.S. Treasuries. The first one of these got done in 1997. JP Morgan created an SPV referencing a pool of $9.7 billion in corporate loans. JP Morgan kept the equity portion and funded about $290 million to cover 3% of the potential losses. SPV sold notes to investors, the mezz portion, for $410 million to cover an additional 4% of potential losses up to 7%. And that $700 million sat in U.S. Treasuries held by the SPV. One common thing here, just to call out in all these structures that we're going to talk about, is it was pretty common for the banks to keep the most junior part of these structures. And that's kind of what was on their balance sheets when all this stuff started to go south. In this case, JP Morgan also keeps the super senior portion of the SPV, but it wrote a separate credit default swap with AIG to offload the risk. This was actually outside the SPV, which means AIG didn't need to put up any collateral.
Yeah, unfunded. Now here we go. This is how things really start amplifying.
Right. So AIG here, they could leverage their own AAA rating, and regulators were fine with that because the risk of a super senior tranche experiencing losses were just super tiny, minuscule. And if it happened, AIG was more than capable of funding its portion.
And I think it's worth noting, right? Like AIG was AAA rated as an insurance company, and they have a ton of other business lines. This is a brand new thing that AIG starts engaging with because it's highly profitable, and because the probability of default on these loans is so low that they're basically getting free money. So there's a whole entity, AIG Financial Products, that gets set up explicitly to go after these business opportunities out of London, no less, to avoid some of the issues of potentially being in the U.S. But AIG is gonna really run with this business, and it's what's gonna get them in deep trouble later.
So without paying anything up front, awesome, AIG could take on a tiny probability of funding losses, supposedly less than 0.2%, which seems reasonable. Because remember, these are corporate loans that the great JP Morgan underwrote.
Right.
You're super duper senior. And so you're not funding anything up front, and you're getting paid $2 million bucks a year, a couple $1 million bucks a year for no capital outlays. This is a great business.
Free money.
This really set the table for what came later, like you said. AIG in particular became the go-to counterparty for these unfunded protection deals, particularly on the super senior tranches, first on corporate loans and later on mortgage-backed CDOs.
CDOs, baby. Yeah, let's talk about CDOs a little bit, because I think we can start putting some of the pieces together now. Banks, capital requirements, credit risk, CDS, etc. I think, if you go back to 2002, dot-com bubble collapsed. Stock market was out of favor. Short-term rates are at 1%. Right, the 10-year treasury is a little bit higher than that, but rates are historic lows at that point. And institutional investors all over the world, right, these insurance companies, pension funds, banks, etc., were desperate for safe investments and chasing yield. And the mortgage industry, like we talked about in part 1, is now this assembly line with originators finding borrowers and selling those primarily to Fannie and Freddie, and then later, through subprime to the banks, securitizing these. Wall Street banks then go find investors by putting these into collateralized debt obligations, these CDOs, tranching them, and then, basically finding, different investors to buy these. So, and don't forget, the rating agencies are a critical part of these, right? Like they're stamping these with AAAs or BBBs, depending on the tranche. And so, of course, borrowers are very happy because they had easy access to credit and mortgages. Originators are extremely happy because they're growing like crazy, and they're very profitable from the fees that they're earning. Fannie and Freddie are happy because they're securitizing a ton of stuff and their stocks are going up. Rating agencies are happy because they're making a lot of money. Investors are happy because they're earning more on these AAA rated assets, right? And so the whole ecosystem is happy. Banks were probably the happiest of all, I think, especially around 2003, when they found that originators were happy to find more borrowers for them and the subprime market starts growing, which means that they're taking a ton of market share. The diversification theory of all of this, that theoretically would reduce the probability, in aggregate across a big pool of mortgages of losses, is the reason why the senior tranches of this, which represents about 80% of each one of these CDOs, gets rated AAA, right? So in theory, that all makes sense. The magnitude of loss from that pool should be a lot lower than, an individual mortgage. And then on top of that diversification, the senior tranche is actually insulated, right, from the first, X% of losses, because you have the junior tranches that are absorbing that first. And so, to some extent, I think it all makes sense. But what broke, I think, is the fundamental question, right? The CDO market up to this point, the way we've described CDO and these insurance contracts, these CDS contracts, it all seems to make sense. It all seems like, okay, yeah, pretty elegant, good way to sort of structure this market. But what broke? Well, I think there are three parts that went wrong. It wasn't a single thing, and usually crises that are this big are not like, single source crises. And so I think there's two things in market structure that broke, and one that is more about debt and leverage. But I kind of think about this in terms of three questions let's dive into. The first question is, how did CDOs go from what are pretty rational funding channels to what Buffett eventually called in 2002 these financial weapons of mass destruction? And to be fair, he said that actually about all derivatives, not just CDOs. But the story of CDOs, after JP Morgan did that corporate loan portfolio deal that you talked about in 97, other banks copied it. A few bankers, notably a guy from Credit Suisse, Chris Ricciardi, I think, and a Merrill banker, also Dominic Delisola, I think is his name. They come up with a way to do that same thing that you talked about with CDS, but in the mortgage market. So basically trying to insure pools of mortgages. Mortgages were actually much better than corporate loans. For one, they require a fraction of the capital relative to corporate loans based on capital requirements. And more importantly, there's a constant supply of them, right? Mortgages are just kind of churning through the system every year as people are buying homes, refinancing, et cetera. So remember that at this point, Fannie and Freddie, in 2000, Fannie and Freddie dominated securitization. And most of the mortgages coming out of this assembly line are conventional loans. So Credit Suisse and Merrill started taking the lower tranches of mortgage-backed securities, the junior tranches, and they were rated A or triple B. They're a bit riskier, and they started repackaging them into these collateralized debt obligations, these CDOs. And the senior tranche of the CDO, about 80% of it, would be rated AAA by the rating agencies. Again, the reason being that if you take a bunch of mortgage-backed securities that are maybe triple B and you aggregate them into a CDO, and then you tranche them, which means that the upper layer tranche, the super seniors, are protected by the junior ones from the first round of losses, then by definition, that senior tranche of riskier mortgages is now insulated and should be safer than if you were to have kept the pool at 100% without any sort of insulation. And so the super seniors of these CDOs that are, repackaged riskier tranches of mortgage-backed securities actually get rated AAA by the rating agencies too. So what are the rating agencies thinking? Because I think this is a critical part of all of this. So number one, there's thinking more diversification. Theoretically, you were taking a pool of mortgages that had low probability in aggregate, like we talked about, and you're pulling all of that. The senior tranche of the CDO is now insulated by the junior tranche. And the rating agencies, importantly, are using models with a couple of decades worth of data that showed that housing prices pretty much always went up. That's also critical, right? These models don't include time periods, by and large, where the housing market all goes down at the same time. So now you had a product, you had the senior tranche of the CDO that generated a yield that was about 20 to 30, sometimes more basis points higher than what Fannie and Freddie were offering with their MBS. And that starts to attract investment from the capital markets globally. I'm sure you came across this too. Some of the books call this ratings laundering, because in a sense you're sort of turning something that's triple B into something that's triple A with just this financial reengineering. I think that's probably a bit too dark, to call it. But I also it is true that in hindsight it feels like, because this whole thing collapsed and it established incentives that encouraged all these terrible underwriting standards, that it does kind of feel like a little bit of ratings laundering, right?
This is really interesting to think about, right? Because I talked about on the first episode how, like, if I had to point my finger at any one group, it would be the rating agencies. But like, if you really think about it, like, let's say S&P said, we're not participating in this. This is madness, right? What probably happens in that case is Moody's and Fitch run away with the profits,
right?
And the market never gets so bad that it crashes.
Yeah.
Right? Because you didn't have sort of that extra juice from S&P also participating, or
right.
Or Moody's does the same thing, or Fitch does the same thing.
Because it's a market structure thing, right? Like, there's always going to be a player in the market, and this is true across the history of capitalism. There's always going to be at least one person in the market that's willing to take advantage of a certain piece of market structure, and they're going to play the game. And so if the market structure is designed in a way, whether organically or sort of like through actual regulation, where that is possible, where somebody can take advantage of a loophole and run with it, then that means by definition every player is probably going to go run into that, because otherwise you're not competitive. So the incentives are there. So one of the keys to this is that the banks themselves loved these senior CDO tranches, and they kept a lot of it themselves. So here they had a AAA rated security. It was generating a higher yield than they could get almost anywhere else, and where they had a front row seat to manufacture it themselves, right? They don't have to compete with Fannie and Freddie. And then not only that, but the capital requirements on these were minimal, because according to Basel regulations or standards, like you said, they had 8% of capital requirements, and MBS had a risk-adjusted weight of 20%. So if you think about it in whole numbers, they were only required to hold $1.6 million for every $100 million of these senior CDOs in their books. So just minimal capital requirements. To them, in hindsight, it doesn't seem this way, but to them, in this time period, this seems like a very capital efficient way to earn return on equity. So every time the bank structured a CDO, they would get paid structuring fees too on top of this, right? So they're earning fees on top of whatever yield they're keeping. They would generate products to trade. So then also, on top of the fees for structuring these, there's also a bigger market, which means that their market making profits go up because they earn a spread on these as they get traded by other players in the market. And then they could repackage the junior tranches again for what it's worth, right? Because this isn't just like mortgage-backed securities getting repackaged into one CDO, but they can actually take CDOs and say, okay, well, I can take the junior tranche of a CDO and then repackage that into another CDO, which is called the CDO squared, and generate even more fees. And now you kind of start getting the sense that this market is running away from itself, right? Like, this is now feeling like something should go wrong here. Now I think is where you get to the point where you really can start calling this a little bit of ratings laundering. They're playing games, right? This doesn't feel like real risk management. So I think that's the first aspect of this, like, evolution from, innovative financial product to a financial bomb. The second aspect is the other side of the same coin, which is poor incentives up and down the rest of this value chain. The rating agencies, like we talked about, would get paid to rate each deal. So every time a bank wanted to ship a new CDO, they took it to a rating agency, and the bank would pay the rating agency. And if the bank didn't get the rating, the bank would shop the deal to the other rating agencies. So the rating agencies are also staffed by people that didn't have the experience or the tools to accurately, evaluate and diligence the risk inside of these. And this is across pretty much everything that I read. They're talking about this. There's a couple of interesting scenes in The Big Short, both the movie and the book, obviously, where they poke fun a little bit at the fact that these rating agencies and the people in them were expected to sit across the table from these banks with highly sophisticated teams and PhDs structuring these things and somehow figure out the risk in them. It was not structured well as a market. And then on top of all of that, going back to the originators, they were built to hustle, right? The only constraint on how they operated was the supply of capital. So if the supply is there, if Wall Street is sort of throwing money at them and saying, go loan this out, well, of course the standards are going to deteriorate. That was the only constraint in this value chain. And when that was gone, it really set off this massive growth with no underwriting standards. The guardrails basically came off. So remember that conversation we talked about between Ameriquest and Bear Stearns, where the bankers are basically like, just go find borrowers. I don't care if there's no down payment, no income verification, low credit scores. It doesn't matter. Just get me mortgages, basically, is what they say, right? That is all happening certainly in 2004, but by 2006, it's rampant. And everybody's focused on fees and commissions and bonuses, poor incentives all the way through. To top it all off, investors funding the CDOs were completely decoupled from the underwriting, and things got opaque and complicated enough that all they really saw was a rating, much of which was AAA. And they didn't really notice that the mix of non-prime and subprime mortgages increased massively after 2003. In fact, going back to The Big Short, there's one character, maybe my favorite character in the book, Mike Berry, who was reading prospectuses of these mortgage bonds, and he noticed that deterioration in mortgages that made up the bonds, the mortgage-backed securities. Yeah, in early 2004, about 6% of the mortgages were 228, so those teaser rate adjustable mortgages that then would pop up to a higher rate. 6% of those in 2004 out of the whole mortgage market, and then by late 2004, so just about a year later, 17% are these subprime, much worse loans. And by the summer of 2005, they make up 25% of the mortgage pool. And that's one of the main things that he noticed that led to him deciding he was going to try to figure out how to short this market. But of course, if nobody else is reading these prospectuses, they're massive, and they're just taking the ratings at face value.
So just on the rating agencies again, I mean, I think so I worked in the debt markets for a long time, and people buy debt based on the ratings, right? The ratings still, it's not like this has changed. I actually think it seems like to me the rating agencies skated through this the kind of the least impacted for all the kind of companies, the types of companies that really contributed to it. What do you think about that? Like, do you think, I don't think did they get really penalized at all, as far as you know, for being participants in this?
Yeah, it turns out that they did, and they had. I'm actually just pulling it up here. They had penalties, I think a little bit over $1 billion. Like, I think S&P in 2015 paid $1.4 billion as a settlement as a result of some of these lawsuits after the GFC. So I think there was some penalties. I think the worst thing is probably reputational.
I actually think when I think about what was the real impact of the rating agencies on all this stuff, I'm not sure about this, but I think that they've lost a lot of business because of private credit, right? This is like kind of when private credit started.
So private credit doesn't require ratings.
Exactly.
I see.
That's like one of the main things about private credit is that they're only dealing with one or two counterparties, so they don't need to get a rating.
Right.
And so I actually think that it took 15 years for the private credit markets to kind of really mature into what it is today, which is kind of the hottest, biggest, sexiest asset class at the moment.
Yeah.
But I wonder if this started out with kind of people being like, these ratings don't mean anything. So why pay the rating agencies when we can just go straight to Blackstone and get a loan that might have a slightly higher interest rate?
Yeah, I mean, I guess the reason they're still around in a sense is because a lot of investors actually require a rating in order to be able to
ratings
invest.
are just baked into the credit markets again.
Yeah.
There's lots and lots and lots of funds out there that they have $1 billion fund, and a percentage of it needs to be in double B auto bonds.
Yeah, by like statutory requirement, right? Some of these pension funds, et cetera.
I think to me the main thing about the rate, because it's everybody was just trying to do their best, responding to incentives, and your point about the rating agency sitting across the table from these PhD bankers is a good one. But I think when it comes to subprime, right? Like, I think anyone who's taken basic stats knows that you need a sufficient sample size to draw any conclusions from, right? And to me, one of the main things that stood out to me in all this research was that there just was no data on subprime, right?
Yeah.
Subprime had never been a big part of the housing market. And so it's not just, what happens if all housing prices fall across the country. We don't have a big data set on that. They also just don't have any data at all on the correlation in performance and returns, et cetera, of what is now like 20% of the origination per year for several years.
Well, and it's a lack of rigor and a lack of intellectual curiosity, I think, in these teams. I think maybe everybody was just very complacent. It's the sense that I get reading some of these interviews. It just boggles my mind that you would stamp with your firm's reputation these products when you don't really understand them. Because it's clear in hindsight they didn't understand them.
I would be curious to know what the compensation structure is for the people that work at rating agencies, right? Because
it's definitely not as high as the banks. That's
right.
for sure.
Well, yeah, that's what I would assume. But then you kind of look at this and you wonder, like, well, is the reason that they were complacent and not curious? Because if someone says, "Hey, if you just do your job this year, I'm going to give you $5 million at the end of the year," I'll probably be pretty lazy.
That's a good segue. I think so. There's one more character we haven't talked about. It's the CDO manager, and that is, I think, actually more than the rating agencies. I think that's exactly how it plays out with them in terms of the incentive structure, because those guys are actually making a lot of money to do nothing. I mean, it's a couple of guys. I think Michael Lewis describes them as like a couple of guys in New Jersey with like a Bloomberg machine. And so, just to maybe give it a little more color, they were paid a fee to select and manage the assets of a given CDO. So in theory, these guys, these CDO managers, were there to work for the investors, right? They're doing the selection process of these mortgage-backed securities that are going to the CDO. But in reality, they were not incentivized at all to maximize the long-term performance of the CDO. They were paid a fee up front by the bank manufacturing the CDO. So, and often these fees were bigger for mortgage securities that were harder to sell, right? So the worse these are, the higher the fee to the CDO manager. And that's like a direct line incentive to trying to make these CDOs absorb as much of these bad mortgages as possible so that the banks can keep churning out and generate more fees. And these CDO managers are paid by investors based on AUM. They're paid on assets under management. They're not paid on performance. So again, to them, like if you think about rationally, these guys don't care about whether the CDO performs or not. They just care about managing as much of this as possible so they can pay clip their 1% of AUM. And they didn't have to invest their own capital either on the CDOs that they manage. So you pretty much couldn't compete as a CDO manager if you didn't cater to investment banks, because that's the only way that you're getting the business. And if you did, you made a killing. And these guys are making millions and millions of dollars. So all of this leads me to my second question, which is, derivatives were very complex products. They had hard to predict second order effects in terms of the market structure. And all of these were completely unregulated, right? So why, I guess, is my question.
How did this happen, right? How did the market become so rotten that it festered and blew up? Meanwhile, you have Ben Bernanke, Tim Geithner, Hank Paulson, super smart, super good, super diligent guys, saying publicly this is fine. This is contained. In order to really understand this, I think you really have to start with banking deregulation in the 70s and 80s, where laws like Glass-Steagall were repealed, which this law did a couple things, but repealing it made it so that a commercial bank could also have a hedge fund and an investment bank. So, for example, one of the things that happened in GFC is you had the banks not only keeping the most junior tranches of these of mortgage-backed securities, they also were originating mortgage-backed securities to themselves, right? To their own hedge funds a lot of the time. That's kind of what was on there. Those were the two things on their balance sheet, kind of going into this. And banking deregulation subprime was illegal until about 1980, in the sense that banks weren't allowed to charge you a higher interest rate if you were a higher credit risk, mortgage.
Yeah. So it just didn't make sense to do subprime.
Yeah, and so there was no way to take out a subprime loan before this, before the banking deregulations of the 70s and 80s, and so this all really kicked off kind of shadow banking, as it's called. And estimates are that about a quarter of credit in general and about 60% of the mortgage market at this time was in what's called shadow banks. And just all the regulations that we've talked about so far around Basel capital requirements, et cetera, these guys were just not, they didn't have to follow those rules. In October 2008, when everything's really melting down, Alan Greenspan, who's no longer the head of the Fed, he comes in front of Congress and said, "I made a mistake in presuming that the self-interest of organizations, specifically banks and others, were such that they were the ones that were best capable of protecting their own shareholders and the equity in their firms."
Yeah, that is a very dramatic hearing. It's actually quite fascinating to go watch it.
Right. I mean, this is one of the lords of deregulation and free markets and self-regulation lashing himself in front of Congress. And it really sums up the philosophy of the regulatory machinery since the 80s. And he's not trying to say that like it's all bad, right? And that he was wrong about everything. He used the word flaw just after he said the quote that I read. Not that the free market view of the world was wrong, but that their approach as policymakers and regulators had a flaw in it. Call it arrogance because of the great moderation, or the sort of belief that academia had conquered all crises. But if they had put in place some guardrails kind of heading up to this, maybe we would have just avoided this entirely.
Yeah.
One of the key stories that stood out on just the lack of regulation in the space was back in 1996, Bill Clinton nominated Brooksley Born to chair the Commodity Futures Trading Commission, or the CFTC. She was an accomplished attorney by then with expertise in financial markets. Historically, the CFTC regulated exchange-traded futures and options, think oil futures, wheat, etc. Well, by 1998, the market for what's called over-the-counter derivatives, think interest rate swaps, credit default swaps like we've talked about, these are generally executed by sophisticated parties and were completely unregulated, even though it was a huge market at this time at over $20 trillion. Brooksley Born in her 1998 concept release, a memo, she wanted to standardize OTC derivatives and bring more transparency into the markets.
This was something that she pitched, right? This is like something that
so
she's
Brooksley
proposing.
Born is coming in trying, and she's saying we need to regulate this huge opaque market. And so she wants to standardize things. These markets were exempted from a lot of regulation. She wanted to put them under the purview of the CFTC, her purview. And she was really warning that derivatives could destabilize the financial system. Brooksley sounds like a good regulator, right? She sounds like she was on top of
If I remember
things.
right, this is not well received.
Right, yeah. So she's like not scapegoated. She's like outcasted from the sort of financial policy group. The most prominent economic policymakers were completely against this. Alan Greenspan, who was chair of the Fed before, at this time, Robert Rubin, Treasury Secretary, and his Deputy Secretary, Larry Summers, Arthur Levitt, SEC Chairman, everybody hates this. Their main argument against regulating OTC derivatives was really just like a recital of the ethos of the time. These transactions were between sophisticated parties, and sophisticated parties can regulate themselves. Regulation would drive derivatives trading offshore, right? So it's just going to go somewhere else instead of outside the U.S. So like we're not going to be the best financial hub anymore, right? We're not going to be as competitive. And it was just unclear on who should regulate this, CFTC, Fed, or Treasury. So the concept was completely killed. Brooksley Born was sidelined.
And she resigns, doesn't she? I think she resigned in 1998.
Right. Yeah. They got Congress actually to pass a law that codified the exemption of OTC derivatives from CFT oversight. Just feels like kind of rude, to be honest. Just leave Brooksley alone. So this this stuff was, we talked about on the last episode how the GSEs, Fannie and Freddie, like their sort of positioning in the world just caused all kind of political rancor. Sort of similar thread here. And looking back on it all, certainly Monday morning quarterbacking, this was just a huge missed opportunity to potentially avoid the complexity. Because at the end of the day, because these problems didn't get solved from a regulatory perspective, nobody was able to see what was really going on kind of across the whole system.
Yeah.
And it just blew up in their faces in the biggest possible way.
Yep. That's exactly where we're headed as we enter 2007. Everything began to unravel, right? So the first bank shock was announced on February 7th, and that was HSBC, and they're the third largest bank in the world, largest bank in Europe at the time. And they announced that they were setting aside about $11 billion to cover bad debts in U.S. subprime. And coincidentally, on the same day, the second biggest subprime originator, called New Century Financial, said that they expected to announce losses for the fourth quarter of 2006 also. And so they're in pretty bad shape. In fact, they're going to file for bankruptcy about 2 months later in April. And then also in April, later on, Washington Mutual, which is the biggest savings and loan bank in the U.S. at the time, also announced really bad results for their Q1 2007. And they also announced that 10% of their $217 billion loan portfolio was in subprime, which is quite a bit. That's really large for an institution like that. So moving forward in July, so July of 2007, two major developments. One, a big bank in Germany, IKB, with about $50 billion in assets, about 25% of which were in U.S. subprime, got bailed out by the German government. They had sponsored an off-balance sheet entity that bought mortgage securities and CDOs, and it was funded with short-term debt. And when the subprime default started to rise, investors got nervous and they couldn't roll over their debts, which we're going to dive into here in a minute. And so, of course, they didn't have the cash to backstop this, and they would have failed had the German government not stepped in. And then the other key failure in July, two Bear Stearns hedge funds that collapsed. And these two funds at Bear had been on the verge since the beginning of the year. In February, the ABX, which is the index that tracks mortgage securities, had declined. Even the AAA rated securities were starting to move down, which is really bad, right? Like that was obviously never supposed to happen. These are super safe. And so, these two funds at Bear had been set up to be boring, kind of steady returns, only investing in AAA and AA rated mortgage securities. They were using a lot of leverage. So they were basically using something like $20 to $30 of debt for every dollar of equity. And the logic there is that they were just sort of milking the spread, right? And the leverage allowed them to generate the return that they needed. One of the funds was started in 2003, the other one in 2006. By March, the managers of these two funds were very nervous because of the rise in defaults. In fact, I think some of the Wall Street banks were actually considering stepping into the individual mortgages. Did you read about this? They were trying to figure out if they could save the borrowers from defaulting, so wouldn't trigger.
See that.
Yeah, so it wouldn't trigger issues with the securities that these mortgages were in. That of course doesn't work. The Bear funds actually kind of in a last ditch Hail Mary try to sell equity, so they try to spin off some of their CDOs into an entity and try to sell equity in them and basically IPO them. That obviously failed. Investors were pulling capital out of the funds. They restate their April losses down to 19%. So again, like emphasizing these funds are supposed to be super safe. They're not supposed to lose money at all. And they post a loss of 19% for April. They couldn't do anything about their short-term debt, which is how they're feeling this stuff. And so these funds are going to fail. So let's talk about that short-term market because, and it's called the repo market, because this is crucial to everything that kind of unravels here in 2007 and then later in 2008. I mentioned we had three questions, right? So we talked about how the CDO market got so rotten. We talked about why wasn't there any regulation. So here's a third question out of the three. Why did the banks have so much debt and so little capital? So we danced around this question a little bit when we talked about capital requirements, but there's one key piece that we haven't talked about yet, which is the repo market. So let's talk about it. The repo, the term repo stands for repurchase agreement. So these are kind of like credit cards, right? To sort of simplify it a little bit. You're paying it back pretty quickly, but different in that you actually are posting collateral, right? You have to give the company that is lending you the cash, you have to give them assets. And investment banks and hedge funds that owned lots of mortgage-backed securities, either as long-term investments or, in the case of the banks, because they were holding them in inventory while they repackaged them for some of the tranches, they're using the repo market to get additional funding using the mortgage securities as collateral. So let's walk through an example. So let's say you have $1 billion. And if you're an investment bank, maybe you use that $1 billion to buy $1 billion in mortgages so that you can repackage them into mortgage-backed securities. So the mortgage-backed securities earn about 6% annual interest, and you have $1 billion in assets. You check the repo market, let's say, and the money market funds inside of the repo market, who are the main lenders, of this cash, they're charging basically, let's say, 4% annual interest for these short-term loans. And let's say you're taking this out for a week. It's a week loan. And, you're going to pay 4% annualized. You can enter into a repurchase agreement where you post your $1 billion in mortgage-backed securities. Remember, you don't have that cash anymore because you used it to buy mortgages and securitize them, but you now post it. You give this money market fund, you basically almost like sell them your $1 billion in mortgage-backed securities, and you get back $990 million in cash. So there's a small haircut between the value of the collateral and the cash that they're willing to give you, has a small safety cushion, right? Like it's a bit of a margin of safety. But it's really small because, these mortgage-backed securities are very, very safe. They're all AAA. So the chances that they're going to go down in price is really, really, really slim. Now you take that $990 million in cash and you do this all over again. Okay, so you go take that $990 million, you buy mortgages, you turn them into MBS, or you go buy MBS directly from somebody who's already packaged these. And then you go post these assets as collateral for a second repo transaction in which you maybe get $980 million. And you do that over and over and over again. Okay, and you can do that 30 times. And so why does this make sense? Number one, you can increase your leverage in a relatively inexpensive way, right? If you're earning 6% on these and you're paying 4% to borrow, you're making a 2% spread on these, right? So that makes sense. That's profitable. Number two, the repo market is happy to lend you at 4% because you're posting collateral. So these loans are fully collateralized that they can liquidate at any time if you can't pay back the loan. Those assets that you're posting are super safe. They're rated AAA. The market for them is really large. It's very liquid. So theoretically, if you get in trouble and you can't repurchase those assets back to repay the debt, they can sell them and get their money back. And then mathematically, this is great for you because you can lever up 30 times. So if you do the math, right, that 2% spread times 30 times on your equity, minus those small haircuts that you get in every transaction when you do repo over and over again, you go from making 6% by holding the MBS. So if you had just invested your $1 billion and just held the MBS, you were making 6%. You can make up to 50+% on that same asset base, just because you're using lots of debt, right? Of course, leverage works both ways, right? So if you're levered 30 to 1, a 2% drop in the value of the underlying assets means 60% of your equity gets wiped. So you can only really do this with really safe assets or in a strategy that somehow protects your downside, because otherwise you'll blow up with a very small loss. Not only that, but you're relying on short-term debt to fund, these longer-term investments, which is always dangerous, right? This is what everybody calls the maturity mismatch, because you're relying on there being credit available for you to roll over the debt every day or every week, whenever you're doing this. If you have to pay it back all at once, and for whatever reason you can't sell those assets fast enough or for a high enough price, you're insolvent, you go bankrupt. All the major investment banks and hedge funds, like the two funds at Bear Stearns, were doing this. So this is essentially the answer, I think, to our third question, right? Like, why and how did the investment banks have so much debt? So that's how. And by July 2007, it caught up with them. The two Bear Stearns funds had borrowed about $11 billion from 16 different Wall Street firms in the repo market, the two biggest of which were Citi with about $2 billion and Merrill with about $1.5 billion in exposure. And remember, most of these funds' assets were MBS, so a lot of it was subprime by this point. And it was even though it was rated mostly AAA and AA, right? Like, as we know, there was a lot of embedded risk in them. The index that tracks these was starting to slide, and these other firms were starting to get nervous that the funds might blow up and that the value of the collateral, wouldn't cover the debt that they had used to purchase these. So in June, Merrill decided to seize $850 million worth of collateral, and they tried to sell it. And to their horror, they find out that no one wanted this stuff, at least not at the price that Merrill wants to sell it for, right? So if Merrill wants to avoid taking a loss on this debt that they had lent to these funds, they can't sell it. And then JP Morgan and Deutsche Bank, which were also counterparties here, pretty much everybody just finds out at the same time that this is not great. Like, the MBS market, it's not as liquid. There are no buyers at 100 cents on the dollar here, and that sparks a scramble. So everyone was trying to figure out how much of these CDOs they owned. On July 31st, both of the Bear Stearns funds filed for bankruptcy. Funny enough, the rating agencies had a record first half in 2007. Imagine that. Yeah. So from January through July, the banks manufacturing MBS and CDOs had realized that the housing market was crashing, and they wanted to get as much of this stuff off their books as possible, as you might imagine, right? So they all rushed to package as much of this, get it rated, and try to sell it. So the rating agencies saw the data too, but they didn't go back and change ratings. They required some credit enhancements on some of these things to get the ratings that they sort of were used to historically, but they kept churning these out. They kept stamping. By July, they started reviewing some tranches. It took months, though, and part of it was staffing. Apparently, they didn't have enough people to review all these old ratings. But they were also very aware, according to everything I read, that a downgrade would trigger selling, which would put a lot of pressure on prices and lead to this snowball effect, potential collapse. Then also in July, later in July, Countrywide announced that delinquency rates on its loans had more than doubled to almost 24%, and that even traditional prime mortgages were affected by this. And to quote their CEO, this guy Angelo Mozillo, on their earnings call, he said, quote, "We're experiencing home price depreciation almost like never before, with the exception of the Great Depression." Pretty ominous to have said that on an earnings call. In August, another company, American Home Mortgage, the 10th largest originator, files for Chapter 11 after tripping its warehouse credit lines. And then 3 days later, BNP Paribas, the largest bank in France, froze redemptions from 3 funds because he couldn't value its holdings in subprime. On August 16th, Countrywide drew down its $11.5 billion credit facility. And this is always, I'm sure you remember from your credit days, and yep. I remember from oil and gas,
always
back in 2015. Anytime that a company draws down their credit facility is kind of a leading indicator of an impending bankruptcy. So basically, everybody's trying to scramble, trying to avoid bankruptcy. About a week later, Bank of America invested $2 billion in Countrywide, and by January of 2008, they bought the whole company for $4 billion, about a sixth of what it had traded for just a year before. So they were at about $25 billion just a year before. And they got bought by Bank of America for $4 billion. In September, several structured investment vehicles. These were off-balance sheet entities that were set up by some of the big banks to invest in mortgage-backed securities and basically create another mechanism by which investors could invest in these. Several of these failed. And Citi had the most exposure. So even though technically they didn't own any part of the SIV, they had reputational risk on the line. So they end up having to buy it back effectively or reabsorb it onto their balance sheet. Citi had about $80 billion worth of exposure to these. And this is what's going to then put Citi in a really bad position, later on in 2008 during the Lehman collapse later on. A lot of the banks start reporting multi-billion-dollar write-downs, and they start warning of more losses coming to their CDO portfolio. And then in November, Citi fired its CEO, Charles Prince, and announced even more losses, so about $8 to $11 billion worth of losses.
That's the guy who's got the famous quote about dancing while the music's playing, right?
I think that's right, yeah. I don't remember who said. Yeah, I think you're right.
Pretty sure it was him who said, as long as the music's playing, we have to dance.
You have to dance, yeah. And then Margin Call, the movie Margin Call, I don't know if you've seen that recently.
A long time ago.
They used that. Yeah, they used that too. Great movie. Okay, so at this point, we're at December 2007. UBS also got rescued by some funds in Singapore and the Middle East. So governments haven't necessarily stepped in, at least not with the major banks yet. But, looking at the economy and the stock market, things don't seem horrible yet. So, we talked about how at the end of 2006, Ben Bernanke and Hank Paulson and others, are thinking that subprime is generally contained. I think by this point, the broader market, what do you think? It looks to me, at least from what I can tell in the data, that the broader market is not expecting a full-blown banking crisis. But I think the players who have a front row seat, so anybody at a mortgage desk, for example, at a major Wall Street bank, is really, really worried. Right. You look at GDP growth, for example, super strong, 4.9% in Q3 of 2007. You look at unemployment, really low at 5%, inflation 2%. The Fed had already started to cut rates, so I think the Fed is seeing the writing on the wall, and they want to support the broader economy a little bit because the housing market is already starting to, deteriorate quite a bit. But nobody's talking about a banking crisis. Nobody is worried about the meltdown that is coming in 2008. No one except maybe, the people on the front lines and the people who kind of live and breathe the financial system on the front lines of these mortgage desks.
So interestingly, in December 2007, the Federal Reserve publishes a probability of recession in the next 12 months. And in early 2007, we're actually at 35% likelihood, which is actually pretty high compared to, that's them saying they think there's going to be a recession. It got as high as a little over 40%, kind of at the peak in that time. So to your point, a lot of people didn't think it was going to be that bad, but the people who were really in the know were forecasting a recession at this point.
Yeah, they're forecasting. Yeah, I think that's right. I think they're forecasting a recession, but I also think that they're not forecasting a banking crisis, right? So I think to your point, they're forecasting probably a mild
would have
recession.
been much higher. Yeah.
Yeah.
All right, so now we're moving into 2008. This is sort of the big year. February starts off with a bang. By this point, Fannie and Freddie had $84 billion in capital against $5.3 trillion in mortgage debt. 2%, right? Basically no margin for error.
Right.
Small losses on their mortgage portfolio would wipe out their capital. Part of the problem is that after Wall Street banks retreated from the mortgage market as prices started to drop, Fannie and Freddie actually doubled down.
Yeah, this is what we talked about in part 1 too, right?
This was an opportunity for them to finally take back market share that they'd been losing for 3+ years to the private label mortgage-backed securitizations. Even though they had no margin for error, they announced their 2007 earnings in February of 2008. They both announced write-downs from deteriorating mortgages, $2.1 billion for Fannie and $3.1 billion for Freddie, which, by the way, was its first write-down ever. During this time, right, early 2008, this is kind of wild, Congress and the Bush White House, they actually signed a law allowing Fannie and Freddie to take on jumbo mortgages, so twice as big as their previous limit. So they were able to go from $400K to $700K. And this has bipartisan support, by the way. Pelosi, Boehner, Bush, notably Hank Paulson was actually against it. Then in March, the first big domino dropped. Remember the 2 funds inside Bear Stearns that failed in the summer of 2007? So Bear itself was now in critical condition for similar reasons. If I remember right, Bear, after those hedge funds failed, invested an enormous amount of their own balance sheet to try to save them.
Yep.
Bear was just stacked up with mortgage-backed securities. I think they had a reputation. They were the smallest of the independent investment banks, and they had like little man syndrome, it seems like, super aggressive.
They were very aggressive.
They used all their mortgage-backed securities as collateral to lever up through the repo market. They traded CDOs. They really did it all. So I think the big thing about the repo market, right, that's short-term debt, and it's really confidence-based, right? So the market just loses confidence in Bear.
Yeah, it's all about trust, right?
Yep, it's the smallest of the 5 banks. It's the most aggressive. There's a quote from their chairman, a guy named Alan Greenberg, from his memoir. He says, "Without reciprocal trust between the parties to any securities transaction, the money stops. Doubt fills the vacuum, and credit and liquidity are the chief casualties. Bad news, whether it derives from a false rumor or verifiable fact, then has an alarming capacity to become contagious and self-perpetuating."
Very much a verifiable fact in this case, right?
Right.
Not a rumor.
Bear goes down extremely fast. On Monday, March 10th, their stock price is $70 a share. They had $120 billion in financing and $18 billion in cash. Hedge funds start to pull their money out to withdraw securities. They're withdrawing the securities they kept at Bear. This is a bank run, right? This is a modern bank run. Their repo counterparties told them they wouldn't roll over their debt at the end of the week. Bear's CEO, Alan Schwartz, goes on TV to deny that they're having liquidity problems, to try to stop the bleeding, of course. That made it worse.
Yep.
Can you imagine today, in a crisis, a CEO going on TV of a big bank and trying to publicly defend liquidity problems?
It's happened in crypto, right? The moment you say you don't have a liquidity problem publicly, like obviously you have a liquidity problem, and
Right.
It only makes it worse.
Right. By Thursday, Bear had gone from $18 billion in cash down to $5 billion. By Friday, the stock was down from $70 a share to $30 a share. It was evident by the weekend that Bear wasn't going to survive another week. So they're scrambling with lawyers and the board and the Fed and the Treasury. They all work through their weekend, and JP Morgan emerges as a buyer of Bear Stearns. They end up separating a big chunk of Bear's mortgage exposure into a separate entity and attached a Fed guarantee with a $30 billion loan on it. JP Morgan would take on the first billion in losses, and the government would backstop it from there. One really key thing to Bear Stearns being kind of making it through, it was really 2 things. One is that they had a buyer, And two is that, over this weekend, I think it was BlackRock in this case, that kind of came in and evaluated the portfolio.
Yep. Larry Fink, he's coming back.
Yep. Yeah, there's Larry. They came in and said that, if the Fed were to lend to Bear Stearns, that they would likely get their money back, which means that the Federal Reserve kind of can use the 13-3 clause of the Federal Reserve Act to use kind of what they think they can use in emergencies to lend into these emergency situations. By Monday, the deal was signed between JP Morgan and Bear Stearns at $2 a share. This later got revised to $10 a share. It's kind of funny to think that somebody made like a 5x on that deal, probably, in like a week.
Yeah.
But Bear was out of business after 85 years. Hank Paulson says in his memoir that everyone was warning him if they didn't get a deal done for Bear by the time the market opened on Monday, the rest of the system might go down.
Yeah, very foreshadowing. It's
kind of one of the funny things reading Hank Paulson's book, right, is that usually when somebody says the system, right, the system, they're almost always like a super pessimistic conspiracy theorist when someone's talking about the system.
Not in this case.
Yeah, not in this case. Hank Paulson calls it the system, the whole book, and he talks about it going down the whole book.
Yep.
And so this was scary.
Yeah, I mean that's why they refer it back to the Great Depression, which is the other moment in time when the system actually did collapse, right? Like you can go back and study Milton Friedman's analysis of the Great Depression. That's exactly what happened. All these banks failed,
right?
Credit markets collapsed. Nobody could get anything.
One of the things that kind of came to the surface to me is like, so what are people talking about when they say the system, right? In this case, I think they're talking about the repo market. That's what they're talking about. They're talking about the way our banks finance themselves. That's the system.
I think that's the first concentric circle maybe in the system, right? Because the moment that collapses, then the broader system of credit, right, like actual lending in the real economy to real companies, industrial companies, product companies, service companies, that all goes down because the banks are not there to lend, right? There's all this credit destruction that happens, and so the system, I think you can almost at that point, if you're going that deep into it, at that point the system equals the economy, like the economy collapses.
Right. So with Bear done, Paulson's attention turns to the next potential domino, Lehman Brothers. Remember that Goldman had become worried about risk in the system and started to play defense as early as December 2006. Lehman had gone on offense. Between 4Q 2006 and the first quarter of 2008, Lehman actually increased its assets by 50%, and its leverage went up to 30-1. A lot of this activity was from financing and investing in commercial real estate. I think at this time, it'll be interesting to learn as we do these studies, like which deal kind of marked the peak, right? Like, so
it's actually a Lehman deal, right?
Yeah, it was Archstone, right?
Yeah,
Archstone deal.
And didn't Blackstone? I didn't study this, but Blackstone did a deal just before that, and they happened to kind of squeak it in, a massive deal. And if they hadn't, who knows if Blackstone would still be around?
Right. This is like this. Lehman's Archstone deal is potentially like the AOL Time Warner deal, right? And just kind of being like, okay. This has gone too far. Yeah. The market started to get worried in 2007, and Lehman was tapped out of unsecured financing, so a lot of the leverage they were using was funded in the repo market. In the midst of all that, Lehman didn't react fast enough, apparently. There were internal emails from people worried about repo that were dismissed. Their securities were marked pretty aggressively on their books. Basically, the prices that they were showing everybody were inflated.
Yeah.
Hank Paulson warned Dick Fuld, their CEO, several times, and he didn't do much. It's hard to tell for sure, but pretty much every source out there frames it this way.
Yeah.
Lehman raised $4 billion in March, but Paulson was recommending Fuld find a buyer, which it sounds like Fuld was resistant to do. It seems like Lehman expected the government would step in, even though Paulson consistently told Fuld they wouldn't, or even that they couldn't, which probably was hard to understand given what they had done with
there's
Bear.
So much moral hazard at this point baked into the full financial system, right?
Lehman announced losses of $2.8 billion on June 9th, and people are now getting very worried. 3 days later, they fired their CFO and their president. That was meant as accountability, right? They had a bad earnings announcement, but it actually didn't help at all. The market continued to lose confidence just like it had with Bear. Meanwhile, rumors started circulating in July that the government was considering putting Fannie and Freddie into conservatorship, basically a government takeover. There was a big article about this in the Wall Street Journal that got a lot of attention. Yeah. Investors held almost $2 trillion in either mortgage debt securitized by Fannie and Freddie or debt issued by them to finance themselves. Some of them started selling. Paulson and the Treasury were really worried because their capital cushion was just so small. If any of their short-term debt lenders refused to roll over their debt, they would just immediately be insolvent. And the worst part was there was no legislation that informed how they might deal with one of these groups failing. Congress finally passed legislation. They created a new regulator. It was really an old one with a new one. They gave the Fed power to look at the GSEs, made it easier for the government to take them over, and it gave Treasury the power to extend lines of credit if necessary. So before this, right, if the Fed needed to understand what was going on at a GSE to really assess the situation, they weren't even allowed to send somebody in. They couldn't force somebody in to analyze the situation.
This is the famous bazooka quote, right?
Right. So Paulson's famous quote that he said he would regret saying, he regrets saying now, was, if you got a bazooka and people know you've got it, you might not have to take it out.
Yeah, you have to take it out, Hank.
The government brought in bank examiners to review Fannie and Freddie's books and actually hired Morgan Stanley. And these guys are horrified by what they see. And Paulson decided they had to take over the GSEs. Ben Bernanke, the chairman of the Fed, agreed. By September, Paulson had briefed President Bush a couple times, and they were ready to do it. They moved quickly, brought the Fannie and Freddie executives into the meeting on September 5th with their regulator that included Paulson and Bernanke, and they laid out the takeover terms. The government would inject up to $200 billion in preferred stock as needed. Fannie and Freddie would continue to support the mortgage market through 2009, then shrink their portfolios. They also needed to stop all the lobbying activities in D.C., and the government would replace their CEOs. This killed the last bit of optimism that remained in the market. This was a clear signal as any that things had just gotten really, really, really bad. One thing to kind of pause and mention here, too, because we mentioned President Bush, is that this is an election year.
Yeah.
And that's like a major factor in a lot of the things going on in the background.
Especially what's coming next, right?
Right. 3 days later, on Tuesday, September 9th, news broke that a potential deal between Lehman and the Korea Development Bank was off. Lehman's stock was dropping like a rock. On Wednesday, Lehman announced a $5.6 billion write-down of its real estate portfolio and $3.9 billion in losses. It wasn't just Lehman either. Everyone expected Merrill might be next. So Merrill, my understanding is that they were the king of the CDO.
Yep.
They had huge mortgage exposure. Washington Mutual, AIG, these guys are all in critical condition. There's a mad scramble to find a buyer for Lehman. At one point, Barclays, the UK bank, looked like it might do a similar deal to what JP Morgan did with Bear, but UK regulators wouldn't budge. They said that they didn't want the US disease to infect the UK.
Yeah.
And one of my favorite things from the Hank Paulson book was after Hank Paulson finds this out, he goes in a meeting with a bunch of CEOs from banks and he goes, "The British screwed us."
Yeah. Well, he regrets saying that is what he says, right? In that page. Yeah.
Right. It's like my first thought was like that this is like in terms of the US British relationship, this is like second to the British are coming.
Yeah. Well, this was the weekend when Hank Paulson's really scared, right? And he calls his wife, and that how we opened this part too. This is where it's happening. Right. Lehman's about to go down.
Right. So the Treasury is pushing Bank of America to take a look at Lehman before that, but they lean towards Merrill instead. Bank of America is pretty well positioned through all this, right? Because they didn't really get into all the crazy stuff. They kind of stayed a commercial bank, not based in New York City, a little more middle of the country kind of attitude.
Yeah, arguably Wells Fargo is sort of the most protected, but Bank of America is right up there.
Yeah, that's right. Wells Fargo did fine through the period. By Monday, September 15th, Bank of America and Merrill had agreed to merge, and Lehman actually files for bankruptcy. The stock market declined pretty sharply now, down 4.7% that day, down 17.6% from the beginning of the year. Bank stocks were in a free fall. Lehman, understandably, was down 95%. Morgan Stanley and Goldman are down 2%, and this had turned into a full-blown panic. And just key to what's different between Lehman and Bear, right? Two things. One, there was no buyer for Lehman.
Yep.
So it had been confirmed by the people doing this analysis that if the Fed was likely to lose money if they made a loan to Lehman. So there was
a big gap.
No buyer, and they can't use the 13.3 clause to bail them out. So they're kind of stuck. There's nothing they can do. In parallel, the same weekend this is all happening, Paulson gets word that AIG might not survive the next couple of days. They had more than $80 billion in exposure to credit default swaps on CDOs that were going bad. The derivatives division of AIG had taken advantage of the parent company's AAA rating to underwrite $440 billion in derivatives, $80 billion of which was tied to subprime CDOs. They were complacent about the mortgage market like most everyone else and saw these credit default swaps, this insurance against the senior AAA-rated tranches as free money. And they were dead wrong in hindsight.
Yep.
And they were a counterparty to most of the major players in the financial system. If they went down, everyone else who thought they had protection against losses might go down too. On top of that, the parent company, AIG, with its insurance contracts all over the real economy, life insurance, all that stuff, they might have failed too if AIG went down, right? So you imagine getting the call that you just lost your life insurance.
Exactly.
The CDS was structured with collateral triggers so that they had to post collateral as the value of the underlying mortgages declined. Their liquidity risk was massive, and they didn't have the cash to manage these triggers. Does this kind of go all the way back to the cashless senior tranche ownership?
Yeah, exactly.
Is that what happened?
And they didn't expect, right? And this is, I think this is a true failure of risk management on their part. But I guess they didn't expect that they would have to post collateral on these.
Right. The government basically takes over AIG. They took almost 80% of the company in exchange for a credit line of $85 billion. They eventually supported it with $180 billion. By the way, one key difference between AIG and Lehman was that AIG was running into a liquidity problem, but their assets were actually okay. So this is again back to the 13.3 clause in the Federal Reserve Act, where Lehman's assets were terrible or at best impossible to value at that point. So the Fed would have to, they could make a loan to AIG under the 13.3 versus they weren't able to do that in Lehman's. And the big concern with AIG was that if it failed, the whole credit market would probably freeze, no lending anywhere, just insolvency everywhere.
Yeah.
One of the scariest things that happened that week, the week of the Lehman bankruptcy, and while we're navigating AIG's issues, especially through Tuesday, September 16th, was that the money market actually froze. Money market funds it's basically the modern bank, right? You're not putting your money because you can earn a little bit more return, and it's as liquid as it gets, right? It's just the cash market that earns a little return for people. These are the funds that finance the repo market, among other things. It includes money from all over the place, right? It's retirement accounts, it's the equivalent of checking accounts, it's money from abroad, and it's also the flightiest capital because it's super liquid, right? You can get it same day. The moment a money market fund drops below $1 in value for every dollar in assets, which is called breaking the buck, the fund just evaporates, and you get what would basically be a modern day bank run, where everybody just wants their cash out now. So that actually happens during this time period. This was a huge source of funding for all sorts of companies. For example, GE used commercial paper to fund itself. They were having trouble rolling over their debts. You heard that right, GE, right? Not a bank.
Yeah. Although arguably, back then.
True.
Financial company, but digress.
This is a $3.5 trillion market. By Thursday, there were outflows of more than $160 billion, and the market for U.S. Treasuries, the safe haven asset, was just breaking down. And not breaking down necessarily in a way like too many people wanted Treasuries, right? So
yeah, exactly. Too many people, and so like there's too much demand for the amount of Treasuries.
Yeah, too many people wanted to own the safest thing, and so the stat that's used for this time is called a failure to deliver, right? Where somebody's supposed to deliver you Treasuries, and they can't find them to deliver you because everybody's buying them like crazy.
Yeah.
Meanwhile, Paulson and Bernanke realized they didn't have enough legal authority to prevent the snowball from getting worse and taking down the whole economy. They realized they needed to go big, and they needed to go to Congress and ask for what they really needed.
Yeah, so I think this really kind of starts the daily timeline of 2008 of the crisis. Like this is like dark mode. This is the worst of the worst. So so on Thursday, September 18th, it's funny because at this point they're talking about what eventually gets labeled TARP, the Troubled Asset Relief Program, and they're trying to pitch this to Congress. By Friday, Treasury announces that they have this $700 billion TARP plan to purchase troubled assets from the banks. Lots of congressmen hate this idea. This is funny enough. This later kind of fuels, or it's one of the key inflection points or catalysts that fuels the Tea Party. Remember that? Mm-hmm. So that's coming. The Treasury needs to back these money market funds because they're the foundation. They're like the backbone of funding in the economy. And so they pitch this. The market rebounds a bit. By the week of September 22nd, 3 of the 5 major investment banks are gone. Right, Bear got acquired by JP Morgan, Lehman's bankrupt, Merrill got acquired by B of A, Morgan Stanley might collapse, Goldman's not far behind. They actually convert them to bank holding companies, right, so that they can access the Fed lending facilities. And the Fed actually started buying commercial paper to try to unfreeze all the short-term commercial paper market. Then Washington Mutual, biggest S&L, gets seized by the FDIC because depositors are starting to pull their deposits out. And then because depositors are starting to pull deposits out, they're worried about Washington Mutual subprime mortgages. So this is actually a classic bank run, right? Like this is legit people lining up outside trying to get their money out. They get sold to JP Morgan. And by the end of the week, the TARP negotiations in Congress are not going well. On Monday, the week of September 29th, on Monday, Congress failed to pass TARP, and the S&P 500 crashes 9%. So I think arguably there's probably two inflection points, I think, about the global financial crisis of when things get really bad, where everybody knows that this is a true, panic and the economy is sort of in question and the system might collapse. And one of them is the Lehman bankruptcy, because I think it drives home the fact that, oh, wow, like the government is not going to be there to backstop everything. So if they let Lehman fail, maybe they'll let everybody else fail. Like, what is happening here, right? So I think even if you look at the charts, even if you look at the various indices and you look at different indicators, there's a big inflection point with Lehman. But actually, the biggest inflection point is here, when Congress doesn't pass TARP. Because up to this point, I think everybody's watching and saying, okay, the government will step in, but everybody, the whole world loses confidence that the U.S. government will be able to deal with this and kind of save the world from another Great Depression, because Congress doesn't pass it. It's like Congress doesn't get it, that, you need to do this to reassure the market, and to not just reassure the market, actually, but to backstop the banking crisis. So more negotiations, throughout the week, lots of volatility. And by Friday, Congress finally passed TARP. S&P ends the week down 9%, but no further, declines after that original crash, but very volatile throughout the whole week. So throughout the rest of October, the U.S. Treasury and the Fed are kind of going nuclear, trying to regain control of things. They inject $250 billion to recapitalize the banks. The Fed cuts rates again. They're now down to 1%. Same thing is happening in Europe. Meanwhile, unemployment starts to tick up, and credit card and auto loan delinquencies are spiking. In November, so you mentioned the election, in November, Barack Obama gets elected president. So now there's going to be a presidential transition. There are rumors that Citi might go under, so the government actually injects more capital into them. The auto companies, which we haven't talked about, they come to Congress at this point in November, and they ask for a bailout because their sales are plunging and they can't fund themselves. And then Obama announces that he's going to appoint Tim Geithner to be his Treasury Secretary, which Tim Geithner was the president of the New York Fed. So Obama basically signaling that there's going to be continuity once Hank Paulson rolls off, once the inauguration happens in January. Then the first week of December, the National Bureau of Economic Research declares that the U.S. had actually entered a recession in December of 2007. And then famously, Bernie Madoff gets arrested too, because his Ponzi scheme, collapses with all the market volatility, $65 billion Ponzi scheme. And then, also the Fed cuts rates finally to 0%, which is where they're going to stay for quite a bit. The Fed also announced that they would begin purchasing MBS and longer-term treasuries to support the market. And after the auto negotiations stall in the Senate for a bailout, the Treasury used $80 billion worth of that $700 billion in TARP money to bail out GM and Chrysler with really, really aggressive terms. Right? I think they sort of learned the lesson of what the chatter in the market. And you can call this a bailout, but I actually think that's too strong a term, right? Because shareholders got wiped. The bondholders, I think, got like 10, 30 cents on the dollar. CEO of GM got fired. Government forced a bunch of executive pay cuts and other requirements. So I think it was a very aggressive, quote unquote, bailout. But the politics of this all were sowed by that point, right? So the markets ended worst year since the Great Depression, right? So the S&P at the end of 2008 was down 38.5%. For the year, massive drawdown. 2009, Obama got inaugurated. There's additional stimulus that gets passed. Banks raise a lot of equity, and the economy really kind of settled down by July 2009. Right? I think that's kind of the start of the recovery.
Right. The thing that really ended this was the results of the stress tests.
Yeah. Right. Which were Tim Geithner's big plan when he came in as Treasury Secretary. Right.
When they came out, when the Treasury came out, when Obama selected Geithner, that was viewed as very positive by the market because it was kind of a continuation of policy, not a big change, not a lot of uncertainty what was going to happen.
Yep.
They announced their stress tests. The market likes that, but is questioning whether they'll be good stress tests. And they come out, they're very diligent, they're very thorough, and I think they require a bunch of banks to raise additional capital or take more government money, kind of thing. So the market likes that, and that was kind of the end. Once they saw kind of the results of the stress tests.
Yeah, at least in terms of the economic crisis, right?
And then we move into the I think this is when QE1 got announced as well,
yep.
right? So now the Federal Reserve's getting involved in kind of a new way, buying I think at first MBS and Treasuries,
yeah,
right,
yeah.
And this is where you start to get the massive long-term expansion of the Federal Reserve balance sheet.
Yeah. which still to this day has not shrunk. So maybe some key stats on the aftermath. So S&P 500 peak to trough was down 57% since October of 2007. Peak unemployment happened on October of 2009 at 10%. 8 million jobs were lost during this crisis. Interest rates were at 0%. They remained pretty much at 0% for about a decade, which created a lot of dislocations in the market through the 2010s and into the 2020s. And then foreclosure rates stayed elevated through like 2015. It took a while for all of this stuff to work its way through the system and for the housing market to stabilize a bit. And just to kind of put it in perspective, there were 10 million homes that were foreclosed.
I think one thing worth noting too is, so in terms of the bear market part of this market cycle, down 57% peak to trough. That is the worst peak to trough in a bear market since World War II. So during the Great Depression, peak to trough for the S&P 500 was 86%.
Yeah.
So this is really bad, worse since World War II, but Great Depression makes it look like a baby.
Yeah. I think the Great Depression makes everything
Wow.
look like a baby, I think that's a wrap. That's the global financial crisis. Should we leave it there?
Let's leave it there. Thanks for studying with us.
So yeah, thanks for studying with us. This is a new project we're trying, so if you like it, let us know by subscribing at crashesfm.com. That'll keep you updated on new episodes and new topical articles that we might publish. Thanks for listening. See you next time.
See you guys.